Hey Sampan, this is Shreya from Samaya, and today we are going to discuss 240, the auditor's responsibilities relating to fraud in an audit of financial statement. Now, first we'll move on to the objective of the auditor with regards to SA 240. The objectives of the auditor are to identify and assess the risk of material misstatement in the financial statement due to fraud. That is, first you have to identify what risk of material misstatement in the financial statement with fraud. Only fraud, not by error here. Fraud, what's the difference between fraud and error is the intention of the party who was the fraudster who had committed the fraud. First, we have to identify whether there exists any risk. Second thing, after identifying any kind of risk, he had to obtain, he have to assess the risk and confirm whether there were any fraud that had taken place or not. For that, what he has to do? Has to obtain some evidence. What evidence? Sufficient, appropriate audit about the assessed risk of material misstatement. That is, in this step two, he had already assessed that there was a risk that the financial statements contain a material misstatement due to fraud. So, how could he obtain sufficient and appropriate audit evidence? Through designing and implementing appropriate response. How he have to respond that. There were five cases or five types. How could an auditor obtain sufficient and appropriate audit evidence is through inspection, inquiry, observation, reperformance, and recomputation. By usage of these five, any of them, not all five, he can obtain sufficient and appropriate audit evidence. After obtaining that, after confirming that fraud had happened, what he has to do? He has to respond appropriately to the identified or suspected fraud. That's it. These were the objectives of the auditor. We first dive into the SA 240. Responsibility of prevention and detection of fraud. Who has the responsibility to prevent and detect fraud? It lies with the management and TCWG. How could we confirm that it lies with the management and TCWG? It's because the design, implementation, and the maintenance of internal controls in an entity lies with the management. So that by internal controls or to properly implement the controls in the entity, that the financial statements are reported as per applicable financial reporting framework, and there were no errors in the financial statements. And moreover, the preparation of financial statements also the responsibility of the management. With taking those two, we have concluded that the responsibility to prevent and detect fraud lies with the management. Management and higher authorities, and the management is TWG. Those charged with governance. How they have to do? Place a strong emphasis on fraud prevention. That is, they have to put some controls or they have to communicate strongly within the entity and its employees, which may reduce opportunity for fraud to take place. And fraud deterrent. Deterrence is something to eliminate all the circumstances, situations, people that cause fraud. This is what fraud deterrence, which could persuade individuals not commit. Persuade is something to forcing, which is affecting the individuals or influencing the individuals not to commit fraud. When there were stringent rules or controls or have eliminated all the circumstances situations that could cause fraud, then what the individual do? They not commit fraud because of likelihood of detection and punishment. What are the responsibilities of the auditor here? These were all the responsibilities of the management to prevent and detect fraud. Then now what are the responsibilities of the auditor? An auditor is responsible to obtain reasonable assurance. He has to obtain what? Reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. This is the phrase we often use in our audit answers with regards to responsibilities of the auditor. There is nothing much we could take from it. What is the risk of the auditor? Risk of the auditor is auditor have come to the entity to achieve something, some objectives. What are those objectives? To obtain sufficient and appropriate audit evidence, to give an appropriate audit evidence, audit opinion. You see, there were a few kinds of inherent limitations of audit. That type one of inappropriation of audit opinion is he auditor is giving a unqualified opinion when there were material misstatements in the financial statements. That is type 1 error. Type 2 error is he's giving a qualified opinion when there were no misstatements in the financial statements. Both were not appropriate. So those were the risk of the auditor, and risk of the auditor was also that he's not able to detection risk. He could not able to detect the material misstatements or any kind of irregularities that had been in the entity or entity's financial statements, even though the audit procedures were planned as per SEs. That is what detection risk is. I've discussed about inherent risk and detection risk, and control risk is something that the internal controls were not planned appropriately. And that deals with the management. With regards to auditor, inherent risk and the detection risk is something we have to discuss about, and we have done that. And the risk of the auditor not detecting the material misstatement, that is detection risk resulting from management fraud, is greater than employee fraud. That is, but the detection risk is higher in place where there was a management fraud. Why management fraud? Why that detection risk is greater in management fraud? Because management frequently in a position to directly or indirectly manipulate accounting records. They could manipulate the accounting records as a whole. An employee do not get so much of scope in manipulating all the accounting records and present fraudulent financial information, or override control procedures designed to prevent similar frauds by other employees. You see, who makes the rules only breaks the rules. Management puts the strong emphasis on the fraud deterrence and put some internal controls to prevent the fraud, and they only override such control. These two things got like they could manipulate the accounting records and override the controls. These two factors would make the risk of the detection risk of the auditor detection risk is being greater in case of management fraud than in an employee fraud. And owing to the inherent limitations of an audit, there is an unavoidable risk that some material misstatements or financial statements may not be detected, even though those audit is properly planned and performed as per SG. Again, they're talking about the detection risk. Here, they're talking about the detection risk is greater in management fraud than the employee fraud because of this manipulating of accounting records and overriding controls. One thing. And second thing is that even though the audit procedures were planned, good planned as per SCs, there were still some limitations for audit that the material mistake cannot be identified or detected. Those were the risks of the auditor. In addition to that, you could also write the inherent risk of the auditor. Auditor shall make inquiries of management internal auditor TCWG employees to determine whether they have knowledge of any actual, suspected, or alleged. Alleged is something without a proper evidence. It's mostly like a bus that was going on, that there was so much air in the entity that someone had done this much of fraud affecting the entity. The management auditor has responsibility to obtain sufficient and appropriate audit evidence with regards to the assessed risk of material misstatement. We have discussed how many ways he could do that. He could do it by inspection, inquiry, observation, reperformance, and recomputation. Now he's doing inquiries. He's obtaining sufficient and appropriate evidence through inquiries. What is he's inquiring? He's inquiring management. You see, you could replace with internal auditor TCWG employees here and write that, depending upon the situation asked in the exam. And most suitable thing is management's assessment. Management's assessment of risk that financial statements may be materially misstated due to fraud. Have to inquire how the management assessment, how whether they had assessed whether there were any risk of financial statements that could be misstated. He's asking about the management's assessment of that risk. Second thing, management's process for identifying and responding to the risks of the fraud in the entity. First, he's asking about to assessment of the risk here, and he second thing after assessing how they were responding to the risks of fraud. That's what the table or flow that we also followed here, right? We first assess the risk of material misstatement, and then we have done some audit procedures to obtain audit evidence. Even they are asking, we are also inquiring. Auditor is also inquiring the management in the same flow. How they have respond to the risk of the financial statements that could be materially misstated. And management, after identifying that, whether the management has communicated regarding those processes that they were implemented here in the second step for identifying and responding to the risk of fraud in the entity, that they have communicated all the processes that have been implemented with regards to the risk of fraud. And third, and the last point is management's communication to employees regarding its views on the business practices and ethical behaviors. This is like the management's or TCWG's ethics, or what they wanted to the employees, how they wanted the employees to work, all the rules and regulations. First thing, assessment of risk. Second thing, response to that risk. Third thing is whether they have communicated what all the process that were done there. And fourth one is their views. There's a conclusion. And responses to the assessed risk of material misstatement due to fraud. This response is with the auditor. With regards to auditor, what he has to do, he has to assign and supervise personnel. Personnel is the engagement team, or personnel in our audit firm, the engagement team here. Evaluate whether the selection of application of accounting policies indicate fraudulent financial reporting. That is, what all the accounting policies that the entity had selected, whether they could indicate a fraudulent financial reporting or not. The financial reporting framework that the entity has to prepare financial statements should be acceptable. It should be acceptable, not fraudulent. And we have to check that accounting policies and incorporate an element of unpredictability, that is professional skepticism, to be alert. That is, and be dynamic. Dynamic in selection on of nature, timing, and extent of the audit process. Whenever we be unpredictability, or whenever we infuse an element of unpredictability, we'll be dynamic in changing the audit procedures or audit program. Whenever we find any kind of information that is could not be achieved, or objective that could not be satisfied with the existing audit program. And this is what with regards to the response. So this is how the auditor has to respond to the material misstatement due to fraud. He has to assign and supervise personnel. He has to check the accounting policies there, and he has to incorporate an element of unpredictability. Management overriding controls. This is the main reason why the detection risk is greater with management fraud than the employee fraud, right? The management's ability to manipulate accounting records and prepare fraudulent financial statements by overriding controls that otherwise appear to be operating effectively. These were they're talking about those 2 points that we have discussed here, right, in the risk of the auditor. Manipulate accounting records and override the control procedure. They are overriding the controls. If they haven't overridden those controls, the controls were normally operated effectively only. From now onwards, put some extra attention, because these were the topics where you could get direct questions on something, a sequence or a flow of things that we could easily understand. We have to learn some new terms here. The auditor, but nothing so difficult, much difficult. These are all the things which we often see in our FI, but we have to incorporate into audit also. The auditor shall design and perform audit procedures to what? Test the appropriateness of the journal entries. Now what? See, he had from here he had found that a fraud had happened. What he has to do? He has to be respond. He have to respond, right? He has to respond appropriately. We are responding now. How? The author is designing some audit procedures for what? To test appropriateness of journal entries. Why only journal entries? See, the fraud had happened in financial statements, right? So what do financial statements contain? Financial statements contain some journal entries. What he has to do? He has to obtain some sufficient and appropriate audit evidence. How could he obtain? He could obtain by inspection, inquiry, observation, reperformance, and recompletion. Now what he has doing? He's doing inquiries. Inquiries to whom? He cannot go and ask the HR about the journal entries, right? He could ask those individuals who is involved in financial reporting process. That's the accounting department. Make inquiries of individuals involved in financial reporting process. The accounting department. Select journal entries. That is, selecting is audit sampling and other adjustments made at the end of the reporting period. Have to select few journal entries and all the other adjustments in the end of the reporting period, year end, and consider the need to test journal entries and other adjustments throughout the period. First thing you have to do, you have to compulsorily review few journal entries and all the adjustments the reporting period end. But you also have to test the need to consider the journal entries throughout the period and other adjustments throughout the period. Have to check for that. This is mostly considered when the fraud was when the fraud was so significant. First thing, what he has to do, he has to test the appropriateness of journal entries. Second thing, he has to review accounting estimates. Why accounting estimates only? Because a lot of frauds or a lot of window dressing in the financial statements happens in the accounting estimates only. Retrospective review of management judgment. Okay, there was a policy in the financial statement reporting is that all the 20% of the sales were treated as a provision. The provision of bad debts was estimated to be 20% of the sales. That was fixed by the management a long ago. When you go and ask these, when you make inquiries with the individuals who were involved in financial reporting process, what do they say? That's a judgment of the management long ago. You have to review those accounting estimates, even the estimates that were retrospective, thus past. Evaluate whether such judgments made by the management indicate a possible bias. That is, whether those have any bias on the part of entities management, that management had placed some bias, had put bias to represent a risk of material misstatement due to fraud. That 20% provision for bad debts, whether that indicate a risk of material misstatement due to fraud, we have to evaluate that. And after that, for significant transactions that are outside the normal course of a business for the entity, that is mostly they're talking about the not arm's length price, the close length price and the related party transactions, or that otherwise appear to be unusual given the auditor's understanding of entities and its environment. Was what he have to do. After finding fraud, he have to test the appropriateness of journal entries, review accounting estimates, and the significant transactions. He have to check for that. And why fraud is done? As we are talking a lot about fraud, why someone does fraud? This could incentives or pressures to commit fraudulent financial reporting. We have few problems in our FR, right? If you're CA final or if you're a K intern, you could get few things like if the profit is crosses this to this year, then the employees get this much bonus or ESOPs, etc. Right? Those incentives or sales personal pressure to commit some or to meet some sales targets, right? Those incentives and pressures to commit fraudulent financial a perceived opportunity to commit fraud. Here, what's the management's responsibility? Management responsibility to do fraud deterrence and reduce the opportunities for fraud. But there exists some fraud, or there exists some opportunity to commit fraud. Then what do? They commit fraud. Incentives, that is something that forced. Option B was an opportunity. Third one is individuals may able to rationalize committing a fraudulent act. That is individual, they themselves voluntarily do fraud. First thing, someone forces or some external factor forces the individual. Second thing, there exists an opportunity to. Third thing is the individual themselves voluntarily commit a fraud. Some individuals possess an attitude, character, or a set of ethical values which are unethical that allow them to knowingly and intentionally commit a dishonest act. With regards to fraudulent financial reporting is done by how the fraudulent financial reporting is done by manipulation, falsification, forgery, or alteration of accounting records or supporting documentations from which the financial statements are prepared. What they're manipulating, falsifying, and altering. They're altering, manipulating, falsification, falsification, alteration, manipulation. What are they doing? Therefore, doing for the accounting records and the documentation on which financial statements should be representation or intentional omission. The financial statements from the financial statements and any kind of events or transactions or any other significant information. That was the events or transactions or any information that misrepresenting intentionally or omission. They're omitting from the financial statement. That's another kind of fraudulent financial reporting. First of all, what they have done, they had manipulated, falsified, altered the accounting records and some documentation. Second, they're omitting and intentionally misrepresenting few transactions, events, and information. Intentional misapplication of accounting principles relating to amounts classification or presentation disclosure. This is what something about amounts classification, presentation, and disclosure was something you already know. And they're what misapplying the accounting principles by these three ways they could achieve fraudulent financial reporting. How the management do frauds? What are the ways management could do frauds? They does frauds with regards to financial statements. How could they do record fictitious journal entries? What financial statements contain? They contain journal accounting records contain. They contain journal entries. What do they could do with journal entries? They could record fictitious journal entries, inappropriately adjusting assumptions and changing judgment. They could what the journal entries also contain. The journal entries contain accounting estimate. That's the second biggest thing, inappropriately changing the judgments and adjusting such exemptions, and omitting, advancing, or delaying recognition. Omitting, they have omitted recognition of few events and transactions. They're advancing. That is the the event that had occurred in the next year, that is later on financial statements. They have accounted that in the previous financial year. So they have made that event or transaction in advance or delayed. The event, something that had occurred this year, they were carried forward to the next year. Anything would be a management fraud technique. Concealing or not disclosing facts. They were like concealing or not disclosing the facts that had happened, like factory fire accident, etc. Engaging in complex transactions and altering records and terms relating to significant and unusual transactions. So with regards to complex and unusual transactions, first thing, what they could do? They could record fictitious journal entries, inappropriately make assumptions and change, omit, advance, and delay few events and transactions, conceal or not disclose facts, engage in complex transactions, altering records with unusual transactions, and misappropriation of assets. Have to whenever you write misappropriation of assets answer, what you have to do is you have to check for financial and non-financial or big plant and machinery or buildings, etc., and write those points. With regards to cash, what how could they misappropriate cash? They could embezzlement of risk. After that, we'll move on to few next class of assets. Stealing of physical assets or intellectual property. That is mostly like a stock in trade or in intangible assets, right? Intangible assets, they could also steal that, like software, code, or etc. Causing an entity to pay for goods or services that were not received. Again, with regards to stock, using entities assets for personal use, like few plant and machineries that we could do use, right? You could use that for personal use. You see, embellishment of receipts, stealing physical assets or intellectual property. This is mostly done when the asset was smaller in size but higher in value. Could or do steal the physical assets or intellectual property, causing an entity to pay for goods and services that were not received, mostly for the stock in trade, and using an entity's assets for personal use. These are the ways you could misappropriate the assets. What are the exceptional circumstances that question the auditor's ability to continue performing the audit? That is like limitation of scope, or the management have the not at all responding to what all the queries, or you see auditor has but had doing so much of inquiries, right? If they're not responding to that, he cannot obtain sufficient and appropriate audit evidence, so he have to leave the audit engagement. We'll see what all the circumstances he could leave. The entity does not take the appropriate action regarding to fraud. You see, they were not at all responding. The management is not at all responding with regards to the fraud. That is, whenever we find any kind of fraud, what the responsibility of the auditor? They communicate within 2 days to the board or management or TCW, any other higher authority. And what do they have to do? They have to give responses. They're not giving. If the fraud is 1 crore or more than 1 crore, they could give what the auditor could do. They could report to the central government. But for the less than 1 year, he should consider discontinuing the audit. And the auditor's consideration of risk of material misstatement due to fraud and results of audit tests indicate a significant risk of material and pervasive fraud. That is, he found that everything was fraud. Everything was fraud. It's completely fraud. All the financial statements were completely fraud, and he is not at all obtaining any sufficient or appropriate audit evidence. He's not only receiving any audit evidence, and he could leave a disclaimer of opinion and then withdraw from the audit. or the audit has a significant concern about the competence and integrity of the management and TCWG. That is, the integrity that is lacking in the management and TCWG. All the three circumstances, he could withdraw. You have to question his ability to continue performing the audit when the management is not responding to the fraud, whether and the risk of material misstatement indicate a significant risk of material and pervasive fraud, that the whole financial statement fraud, and the auditor had to question the competence and integrity of the management and team. These all things he has to question the audit, and this is I've already discussed, and this is what with regards to SA 240. Thank you. Please leave a like and do share it with your friends, and do subscribe your channel